guys, I'm Liz, and this video is about the statement of cash flows. During this presentation, I will be covering what it is, its history, when and where it came into being and who was involved, its purpose, why it came into existence, its construction, how to create one, its relation to other financial statements, how they all connect, and its usefulness, how and why businesses use it to their benefit. With much to cover, let's get started. So what is the cash flow statement? First off, it's one of several financial statements used for external reporting. Also, it's a period statement, typically covering a quarter or year. And lastly, as the name suggests, it's a report of an entity's cash flow activities, which are separated into three classifications: operating, investing, and financing activities, all of which we'll go into more depth later. Now, why are there cash flow statements? Well, imagine running a business and you want to invest. You discover you have no cash and wonder why. That's what happened to an iron company in 1863. The manager had an idea and created a comparison balance sheet which compares account balances between different periods. But it didn't explain the change in the cash account. Also in 1863, the Northern Central Railroad included an outline of their cash receipts and disbursements in their annual financial summary. In 1902, a steel corporation came up with a prototype of the cash flow statement called the fund statement. This report summarized the changes in funds, or working capital, during the year. Working capital was calculated as current assets minus accounts payable. During the 1920s, it gained popularity. In 1951, the Accounting Principles Board was the body in charge of setting standards for financial reporting. By 1971, the fund statement was required by the Accounting Principles Board when they issued Opinion Number 19, but it wasn't perfect. Although the fund statement was somewhat useful, there were significant issues with it. Dissatisfaction among users and preparers was prevalent. There was no specific definition of funds, causing inconsistent reporting between companies. This made it difficult for users to compare the finances between companies as well as evaluate those businesses. To make it more difficult to evaluate a company's finances, inclusion of any non-cash investing and financing activities were required to be reported, and activities were classified as an inflow or outflow rather than by type. This idea needed a fix. In 1973, the Financial Accounting Standards Board succeeded the APB. During the early 80s, the Financial Executives Institute encouraged a cash emphasis in their fund statement. The FEI is a network organization for senior executives. It was found that in 1980, only about 10% of Fortune 500 companies focused on changes in cash rather than working capital. By 1985, that increased to 70%. In November 1987, Opinion Number 19 was finally superseded by the Statement of Financial Accounting Standards Number 95. This settled several issues. Firstly, it replaced the fund statement with the statement of cash flows. By doing this, the definition of funds was narrowed down to cash. Secondly, it created consistency of reporting. And thirdly, users could more easily evaluate and compare companies. Hence, the cash flow statement has several purposes: to explain the change in cash during a specified period, to provide consistency for easier evaluation and comparison between companies, to evaluate the management and financial standing of an organization so as to entice investors and prove to creditors that the company is a low-risk borrower, and lastly, to help users make decisions, which will be covered in depth more later on. For the fun part, we will now learn how to construct a cash flow statement and find out how all of the financial statements are related. As preparation for making a cash flow statement, the income statement, statement of retained earnings, and balance sheet need to be prepared in that order. The reason for that is because the profit or loss from the income statement is needed to prepare the statement of retained earnings, and the calculated amount of retained earnings from that statement is needed for the balance of retained earnings on the balance sheet. After those three financial statements are prepared, we can start the cash flow statement. Note that while I go over the sections of this statement, I will explain how the cash flow statement relates to the other ones. The first part of the cash flow statement and any financial statement is the heading. This answers who the business is that the document is for, what document this is, and when is the period or day the document is covering. As you can see, the first line is the name of the organization. Next is the type of financial statement, in this case, statement of cash flows. And lastly, since it's a period statement, the last line follows for the period ending on the last day of the period. After the heading, we move on to the first section, operating activities. It's crucial to know that there are two options for constructing the cash flow statement, but the method you choose primarily impacts the operating activities section. Those methods are the indirect method and the direct method. Let's take a look at the format of each one as I inform you about each method, starting with the indirect method. With this method, we begin with the net income or loss from the income statement. Next, we list the adjustments to reconcile net income to net cash flows from the operating activities. The information you need to do this is found on both the income statement and balance sheet. In the example that I have prepared, we must add back non-cash or accrued expenses, such as depreciation expense and the loss on disposal of a long-term asset. Next, non-cash or accrued revenues must be subtracted, such as the gain on disposal of a long-term asset. After that, adding back increases in current liabilities and decreases in current assets, and subtracting decreases in current liabilities and increases in current assets. All of that information can be found on a comparison balance sheet, as mentioned from the iron company that began all of this in 1863. Take note that current assets such as notes receivables and short-term investments and current liabilities for financing are excluded. Those are for the investing and financing activities section. Once all the adjustments are totaled, you add or subtract the sum or the difference to net income or loss to arrive at net cash provided or used by operating activities. As you can see from this method, the operating activities section basically restates the income statement in terms of cash generated from operations. But it's about more than just that, which we will now see from the direct method. This method separates cash flows from operating activities by cash receipts and cash payments. In other words, it shows the sources of cash and uses of cash from operations. To begin the operating activities section using this method, we begin with the subsection receipts. This includes cash collections from customers from the sale of goods or services, interest revenue, and dividends revenue. Next, we total cash receipts and then move on to the subsection payments. This includes cash payments to suppliers and employees, and for expenses such as interest and income tax expenses. With the direct method, a user can clearly see the cash flows from operations. After seeing how the operating activities section is prepared using both methods, you can see that they are significantly different. As mentioned before, the direct method clearly shows the sources and uses of cash. It's direct by individually reporting cash revenues and expenses, whereas the indirect method is indirect or unclear in showing where the cash flows from operations. It is for this reason that the FASB recommends the direct method and external users prefer it. Despite its preference, it's the least popular among businesses because the FASB requires a separate schedule similar to the indirect method if businesses choose to report with the direct method. The opposite is not true for the indirect method. There are no additional requirements and hence less work, and it's more cost-effective when reporting with the indirect method, making it the most commonly used. In addition, it's easier for most businesses since external financial reporting is done on an accrual basis. But they do have a few similarities. Both methods result in the same net cash amount from operations. Also, they both report changes in current assets and liabilities, just in different ways. The indirect method is clear in showing those changes through its adjustments to net income, whereas the direct method includes those changes when calculating the cash receipts and payments for each item listed. Furthermore, they both require information from the income statement and a comparison balance sheet. And lastly, the rest of the cash flow statement is reported the same way under both methods, which we will now continue covering. The next section of the cash flow statement is the investing activities section. In general, it reports cash transactions related to long-term assets such as purchases of and cash from the sales of property, plant, and equipment, natural resources, intangibles, and investments. It also reports the cash issuance and collections of notes, receivables, and other loans the business made. After all of those have been listed, they are totaled to arrive at the net cash used or provided by investing activities. I want to mention that any payments or negative amounts are indicated by having parentheses around them. Next up, we have the financing activity section. It reports cash transactions related to changes in stockholders' equity with the exclusion of net income or loss, since that's covered by the first section, operating activities. Such transactions include the issuance of common and preferred stock, the purchase of treasury stock, and the payment of dividends found on the statement of retained earnings, minus the balance of dividends payable on the balance sheet. Furthermore, it reports cash transactions related to changes in long-term liabilities and current liabilities related to borrowing, as previously mentioned, typically consisting of the issuance and payment of notes payable. Like the other sections, total the figures from these transactions to arrive at the net cash used or provided by financing activities. From here, we can now calculate the net change in cash between prior and current periods. This is found by adding the net cash used and provided by all of the cash flow activities. Note again that a decrease is indicated by having parentheses shown in the example I have. The net cash change is added or subtracted from the ending balance of the prior period shown on the line under it to arrive at the ending cash balance shown below that line. When it matches the ending balance shown on the balance sheet, the ending cash balance is marked with 2 lines under it, and voila! But that's not all, folks. There is one more section, non-cash investing and financing activities. This section can either be included as a separate schedule of the cash flow statement or disclosed in the notes. It reports exchanges or transactions of significant non-cash items for other non-cash items. These include the purchases of non-cash assets for equity, debt, notes, or bonds, exchanges of a non-cash asset for another non-cash asset, payments or retirements of debt for equity, and exchanges or conversions of preferred stock to common stock. This is useful for users to know how much of a business's assets are financed or not. And speaking of useful, let's talk about the ways in which the cash flow statement is useful. One way it's useful is for evaluations. It helps to evaluate a business's going concern and see if there are any indications of the business headed towards bankruptcy, as well as how the business is truly performing financially. It also helps to evaluate whether management is making good decisions and whether investments and projects are successful in generating cash. Another way the cash flow statement is useful for is predictions. It helps to predict future cash flows and growth, as well as the ability to reach financial goals such as paying debts and dividends. Lastly, it's useful for decision making. Through the use of evaluations and predictions, it helps to make plans, decide whether to increase lending or to invest in other assets or projects, as well as if external users should lend or invest in the business. And lastly, it's to help management decide if any corrective action needs to be taken, if there are actual cash flow results deviating from what was budgeted. In conclusion, the cash flow statement is highly beneficial and important to both internal and external users. For that to happen, users must understand its construction. With two methods yielding slightly different information and several sections of activities, there's much to learn about a business from this document, hence why it gained significance over the course of its history to where it is today as one of the 4 financial statements. If you'd like to learn more about any of the topics covered, feel free to check out these sources. I hope this information comes in use for whatever purpose you have sought it, and thank you so much for watching.